All right, what's going on, everybody? Rob Satcher from Feedbackwrench, and I'm here with Matt of Accounting Forward.
Accounting Forward.
Accounting Forward. What's your URL or what's your domain?
Yeah, it's accountingfwd.com. So forward, but abbreviated, accountingfwd.com.
And the reason why we're here is we've got new tax implications that are probably coming because of the new president, right? A lot of people know that we had kind of a before the Tax Cut and Jobs Act of 2017. Then we had the current era of the Tax Cut and Jobs Act. And now there's going to be some implications for businesses. So if you're a business owner, if you're a general contractor, construction guy, you've got your own home services business, maybe you're a lawyer, it doesn't matter what line of business you're in. This is going to be relevant for you. And what I love doing is interviewing accountants and talking with accountants to help add value to people, because there's a huge difference between people who just do tax returns and those that add value. And what you'll see is that your typical, I kind of call it your typical CPA or your typical accountant out there, unfortunately, has built up a business model where it's all about just doing as many tax returns as they possibly can. And they know that if they do that and they increase their prices every year, it's just this attrition model. They can make a lot of revenue supposedly, but really what happens is they're too busy to actually give you the insight. In fact, you were just talking about, here we are in January. Customer comes to you and they're like, what can I do to reduce your taxes?
I was like, I wish you would have come to me, a month prior so we could actually take a look and do some planning. And there's still planning to do after the year's over, but a lot of things that have to be done during the year. So it's great when businesses are proactive in that sense to be able to, sit down and take a look at things in November, December, so we can make sure we implement things before the year is actually over. Because once the year's over, December 31st is over, there's not as much we can do for that tax year, but there's still some stuff. But it's just really making sure we're planning and being proactive.
Yep. And now I call that the outsourced accountant model, but really what it is somebody that provides year-round tax advice. And this isn't just a schlep for Matt here. We happen to be in the same office. We had connected, and all of a sudden it's like, oh my gosh, we have all this stuff in common, a lot of values, commonality, a lot of commonality in terms of tax planning. Now, I don't have my a tax firm or anything. I had Nuance Financial before. They do a good job, but I really liked what you were showing me. In fact, you really invest in tax plans. Your whole goal is to look at what they're doing and decide what are the levers that we can pull in order to help them pay their fair share and not a penny more. But folks, if you own a construction company, I'm telling you, I say construction, because that's like half my clients. Right? We do marketing, but he does tax planning. He does year-round tax planning. He does year-round tax services, year-end tax services, everything. But if you want to actually control your taxes, you cannot rely on people that do year-end taxes. You legitimately can't. They are not in position to add value.
Yeah, they're very, most accountants are very transactional based. They operate on a transactional, they'll pay you for a return or they get charged by the hour. And they're just, because us accountants, us CPAs, that's kind of like how we think. You think of a stereotypical accountant and they all think a certain way. They're not, I guess, they don't look at it as business owners like a lot of business owners do. They're really looking at forward looking, they're planning down. Accountants just, again, they're transactional. They're not as forward looking as they should be. So that's where I'm able to provide a lot of value. And again, get beyond the compliance stuff. Bookkeeping and tax preparation, that's compliance. But I try to say, how do I add value? And that's really implementing strategies and plans that are going to serve you for many, many years to come. It's a one-time plan. I mean, of course, we have to change the plan, throughout the time. But tax prep, that's just, recording everything that happened. But the plan is really how you save taxes.
And folks, this isn't like a chiropractor where you're like, hey, my back hurts. It's like, oh, if you come in for the next 700 adjustments, you'll actually be good. I'm telling you, you're going to pay more taxes. And so I always think there's kind of three things you end up getting, right? So the first thing I think a good accountant does is that they mitigate taxes and help you build wealth. Like make my money do better. Number two, they save you time. You serve as a staff alternative in a lot of ways. Now, your model isn't like you're grinding away doing every single bookkeeping thing and every payroll model. You're more of a tax planner. But I got a lot of guys where it's like if you can just be an alternative to them hiring an accountant, having that patty part-timer that comes in, that's worth $1,000 a month. That's worth it. And then the last thing is compliance. Of course, it's important to have a tax return done right, but that's the main thing. So I do want to move on here. We're going to talk more about how do you actually mitigate taxes. And I'll just throw this out there. I've found that there's three major ways if you are a business owner, and that's if you earn 1099 income. You could be an Uber driver, not in California. You could be an Uber driver. You could be like, what are the other 1099 situations that you often see out there?
Yeah, it's people, contracting for other businesses, might it be special trade, plumber, painter, maybe it's a digital website, graphic designer. There's a lot of different things out there. If you're getting paid for the work you're doing outside of a W-2 wage, like a job, if you're a handyman, you work on Fiverr, you're doing DoorDash or kind of,
a nanny, a daycare,
yeah,
or something
nanny,
like that.
any type of work that you're getting paid for that's not through a traditional job, W-2. Any money you're receiving, it's a 1099. And
This is relevant to you if you have that. And
Yeah.
and the reason why it's not just so that you can call Matt and get his services, which you should genuinely, but it's that it's where all the fun tax planning is. Like, we're going to show you some before and afters here, folks, they're pretty stunning, actually.
Yeah.
They're going to be before and afters for the new implications that we think are going to come with the Biden presidency, and we'll dive into that.
It's not just the Biden presidency; it's also the Senate flipping to the Democrats. Because without that, Biden, I don't think, can push through his new tax plans. And because the Senate went both Democrat in Georgia, that opens the door for tax change to likely happen here in 2021.
Yep. Now, there's kind of three framings that I wanted to do to talk about real quick, because it's important to frame things up.
Yeah,
now,
sure.
I certainly have a position, and it's okay if Matt doesn't agree with it or if other people don't agree with it. There's a couple of core philosophical things that come up. So first of all, this isn't about whether or not taxes are good or bad. There is this question of, is it better to have your employers and the people down the street, the gal who's got her own business, keeping more of her money, or is it better to hand it to the government in order to do things? Now, I have a perspective there. I feel like each one of us act in a fiduciary manner for our own pocketbook.
Yeah.
A little bit more than what a bureaucrat tends to do. I know some people that think differently, but there is this first philosophical question. I believe I like having my neighbors, my customers, your customers, you having money in your bank account rather than having money in the federal treasury.
Right. Yeah. And what most people I come to see don't really understand is that the tax law is really just a book of incentives. The tax code is written as incentives. The government wants us to do certain things, and if we do what they want us to do, well, then we're going to get rewarded by a tax benefit, a tax cut. So that's really what it is. All income is taxable unless the government says it's not. Same with all expenses are not deductible unless it is. If you're able to comb through the tax 6,000 pages worth, it's really just a book of incentives to get us to do what they want us to do. Because it's more efficient if we do it than the government does. I know most people can agree the government's not the most efficient with their processes and then how they spend tax dollars. But so it's more efficient to have us do it on their behalf.
And the top level things are, the government wants land to be developed and turned into just development, right? So that's how people might hate Donald Trump, and that's fine. But there's a reason why his taxes are so low. When you get into real estate, it's considered a passive. There's all sorts of cutout laws for real estate. But there's a ton of incentives to try and get development because we want development. And there's tons of incentives for people to build houses. We want housing. We want food. We do all sorts of tax screwing around in agriculture. We subsidize it. We pay for it.
Providing jobs. There's so many different things that incentivize. The government wants jobs. They want real estate, low-income housing. They want all these things. And if they can get the citizens to do it, it's cheaper for them to give a tax cut. You look at, let's say, a scenario of, let's say I own $2 million worth of real estate. I'm just throwing out numbers, $2 million. And for that, I would have to pay a normal tax rate on that of $100,000. Let's say $100,000 is my tax bill on that. Well, the government can give me a $100,000 tax break for the $2 million of housing I provided, low income, whatever it might be. That's what they want, housing. It's cheaper for them to give me a $100,000 tax cut for $2 million worth of housing than for me to pay that $100,000 to the government. And now they got to turn around and turn that $100,000 into housing.
And that's a unique perspective. So that's a lot of our political divide comes to that issue. I mean, I think the media sensationalizes things and keeps us at each other's throats often because it's what drives clicks. But that's a philosophical difference right there is, do we like the idea of helping somebody who would have $2 million in real estate, which a lot of you, if you're somebody who's watching this and you're not a business owner, you haven't been out there, we're going to talk about these different phases of life of income. But if that's you and you hear $2 million in real estate, we both know scores of people. I know scores of people that, they bought, instead of buying a townhome or renting an apartment, they applied for a duplex. They did what's called house hacking. They lived in the closet in the basement and rented out like 3 rooms in that duplex or triplex or whatever it is. As soon as they did that for a year and a half, they took that and they found somebody to replace where they were, and then they got the next duplex. And next thing you know, and they're doing this with regular FHA financing. I know some guys at Side by Side Realty and the Duplex Doctors. There's this millennial investors group here on Facebook for Minneapolis, where it's very common for people to easily, and you don't even have to be that smart. Like, you can actually be kind of dumb. You can go do whatever you want and get into real estate. Owning 4 or 5 buildings after about 10 years is not that out there. And the question is do we want to, if you want to increase affordable housing, you can either give supply more money, or give demand, give renters credits to like go afford more housing, or you can increase the supply by helping investors get involved in housing. And that's one of the things that's another fundamental change. So first is, do you equip business owners, investors, and people with money, or do you equip government who then hands it to people? But there's a fundamental problem that I see personally when it comes to when we want to give a subsidy to help housing out. What happens is everybody then has low-income housing dollars. So then what happens to rent prices? How are rent prices right now? How are they? Like, they're way too high. And the reason why is everybody, they might have low-income housing subsidies. There's a supply problem. So anyways, that's another philosophical difference. So.
Yeah, and same thing goes with job creation. If you give the business owner a little bit of tax cut, well, that money is going to go. I mean, people have different opinions on how business owners take those tax cuts, but essentially, if you're taxing businesses more, that's less money that can go towards job creation. And again, the tax bill, what's it, 20% corporate tax rate right now? So 20% of $100,000 income, let's say $20,000. Well, that's going to be more efficiently used on the business owner side to create a job than the government taking it, having to employ people to then find jobs. Like that $20,000 only turns into $5,000 by the time it goes to the government.
And whether you agree with that or not, that's not the point. It's true. It's what happens. There's 2 approaches to it. So the other thing that I want to frame up here is this: when we get into this, I want us to remember that I think there's kind of 3 or 4 stages of kind of life that happens. And there's this income quadrant from Robert Kiyosaki that I would bring up real quick too. But, when I first the cash flow quadrant, exactly. When I was young, I worked really hard. I worked at a restaurant. I actually dropped out of college right away. I had a full ride scholarship to go play football. I was too busy drinking and partying and had to come home and grow up. Got a job bussing tables, being a host at a Perkins. I busted my tail as a server then, working overnights 5 days a week, cleaning, scrubbing. Like, it was 2.5 years, 3 years of really 2.5 years of really hard work. Then I got hired in retail. I went to Best Buy and I worked my buns off. I worked all those ugly shifts. I didn't have any kids, I was grinding. And basically I learned all sorts of good things there, but I did come to this conclusion of like, I don't like this path right now. I have learned a lot of things. It was basically like my tuition. I went back to school, did a bunch of different things, but that was kind of like my first income years. Now, and I think the majority of Americans are kind of in this, I have a job, maybe I make between $30,000 and $90,000. You get paid by your employer, and that's good. There's nothing wrong with that. The second phase that I see is as you start to either become a better leader and manager at your W-2 job, or maybe you start doing, you break off and start having your own company, or you start doing some things differently. I see a lot. I know personally, my business is built up of people making between $100,000 and probably $350,000. And what it is they're self-employed, right? So do you know the cash flow quadrant pretty well? So what is the cash flow quadrant? Because I think I just talked about being an employee. That's the first one.
Then you got self-employed or specialist, such as a doctor, an accountant, or a lawyer, someone who's a specialist, have their own practice. Like I have my own accounting practice, or self-employed. Small business is another way to describe it as well. Small business. So you got the employee, the small business, and then on the right side of the quadrant, you have the business owner, which is the big business owner, where you have a lot of employees, so it's treated more like an asset because your employees are working.
I always think the operations, people's time and your system and capital is creating profits while you sleep.
Yep. So employee, specialist, self-employed, small business, big business, and an investor is the fourth quadrant in Robert's cash flow quadrant.
Mm-hmm. So the whole idea, the reason why I'm bringing this up is what I've seen, and we're going to show two scenarios here. If you're an employee, there's not a lot of fun tax stuff to do. It's really not.
And it goes back to what we just talked about, is because the tax incentives are for people who are able to contribute to society and make society better. And employees can't do that necessarily. Like they can invest, they can become an investor and invest in the economy. Then you get tax benefits for that. But again, the tax code is written as incentives mostly for business owners, because business owners, real estate investors, they're the ones that are able to contribute to society through job creation, through housing, through many different means.
And I think a good way to tweak that is it's not that if you're a W-2 person, you don't contribute to society. That's not what you're saying.
Right.
What we're saying is there's a multiplicative effect of if I can increase my wealth, but if I provide jobs, I increase exponentially. Like by me starting my own business, I've created 3 jobs. It's been pretty cool. I have 3 employees that I pay. It's a lot of stress. And then as you grow. So we just wanted to frame all that up. So if you're still with us right now, there might be more than one video in here, but, first off, let's just talk about, I think there's 2 scenarios that I really want to talk about and look at here. I'm going to ignore the employee thing. If you make $30,000 to $90,000 and you're a W-2 employee, you're hosed in terms of tax planning. There's not a lot you can do. In fact, it's probably the least tax efficient thing that happens.
Unless you, again, decide to invest in real estate or invest in the stock market. If you take your W-2 wages and invest, there's opportunity. But for the most part, if you're not doing anything with it, there's not much we can do, unfortunately.
But if you start a side gig and make money that doesn't come from a W-2, or if you buy real estate and you start buying, holding, and buy and hold or flipping, you could flip and make capital gains. You could buy and hold and get passive income. There's a series of different things. If you bought stock outside of the qualified plans and you started doing some of that, that's just kind of normal, different type of capital gains income. But side hustles, real estate are usually what people are doing, or you start your own business, save up. And you can even do some lending if you have some capital laying around. There's such thing as a checkbook IRA. A lot of people don't know this. Maybe you have, I don't know that I always recommend it, but there's a lot of folks that have old IRAs of, $500,000 sitting in an IRA and they'd like to deploy a portion of that different. You can do self-directed IRAs, not current 401k plans, but there's some interesting stuff you can get into. But let's just shift right now. So Matt, what are we talked about 4 or 5 different buckets that the Biden plan is really going to impact. But the scenarios that I wanted to talk about is somebody who, let's just imagine it's a you or an I who, let's just say you brought in $200,000 in revenue. You had about $70,000 in write-offs. So you have a net profit of about $130K.
Sure.
That's one scenario. I know lots of people in that boat. And then the other one would be, let's say you have an operation of 7 or 8 employees, right? I know tons of people like this. You might not, but they're out there. In fact, I bet if you're listening to this, it's because one of your employees sent you this video. Maybe you watch YouTube, I don't know. But let's just say you drive maybe 1.2 million in revenue, which sounds astounding. But when you have 5 employees and you pay them $50,000 to $70,000 a year, and then you got to buy trucks and equipment or whatever that is, there's a lot of people that make good money. They make $600,000 a year because and the reason why we're using this scenario, to be frank, is because there are so many folks out there that are like, people, if you make more than $400,000 a year, you should be paying more taxes. And it's like, so somebody who risks everything, because guess what happens when the economy goes down to these guys? They're the most leveraged. They're the ones who get bankrupted immediately. These are the folks that when cash flow is bad, they're not taking any income. They're the ones that have to hire accountants to play games with. And but on the other side, they have upswing. So these are 2 scenarios: $600,000 in net profit and $130,000 in net profit. And that's kind of the idea that I wanted to frame up here. Now, talk to me a little bit about the current situation versus the proposed Biden bill. And we can hit on some of these different changes, but the main changes are there's a self-employment. You want to hit on these? What are kind of the main buckets that you see probably changing?
So there's no guidance, nothing's been officially released, but we have a bunch of information that was, proposed during the campaigning. So we have a good idea of what Biden wants to do. And one of them being increasing corporate tax rates from 21% to 28% for the highest level. Capital gains rate is going to increase. For right now, it's set at 20% long-term capital gains, and now it will increase to 39.6%, so almost double from 20 to 40% long-term capital gains. The top individual income tax rate right now is set at 37%. He wants to increase that to 39.6%. FICA tax, that's a big one.
Yeah.
Especially we can get into that a little bit later here. But if you're self-employed, you're paying the employer portion and the employee portion of 15.3% combined.
Yeah.
So an employee, you only pay your share, and then your company pays the rest. Self-employed pay both.
So I love pumping the brakes on this and helping people understand what is Social Security tax and Medicare tax combined.
Yeah.
And then we call those self-employment taxes. And I'll cover real fast because I'm a dummy and I'll just explain it like I'm explaining it to me. Imagine you have this, you made $200,000, you subtract $70,000 in deductions, you have $130,000 of net profit. And then you're taxed in two different ways, either as a Schedule C, or we call it an LLC, or you might convert to be an S Corp. Mm-hmm. When you are out of the box, every bit of income you have, if you were just to go start babysitting or start your own little side gig or whatever, it's all just out of the box taxed as a Schedule C, just as an LLC or
sole proprietor. Yep.
Sole proprietor. And what happens is you take that $130,000 and the first taxes you pay are Medicare and Social Security taxes. Now, if you would have, and those two total combined equal 15.3%, but the Social Security side is 12.4%, and you would only pay that up to this, what's called the Social Security limit of $137,700. So you pay 12.4% all the way up to $137,000, and then everything above that, you only would pay Medicare, right? So that's how most regular sole proprietors are taxed. Now, on the other side, what will happen is people will talk to people like Matt and start to understand there's some interesting things you can do with this S Corp. And in S Corp, what you would do is you would actually convert and do this S election, and then you would pay yourself this reasonable salary. So maybe out of that $130,000, you might pay yourself a $50,000 salary. And then the rest of it you would take as what's called a dividend or distribution or owner's dividend. The owner's dividend is not subject to any of the 15.3% self-employment tax. Also, there's this additional thing that the Tax Cut and Jobs Act brought up where you get a QBI, Qualified Business, what is it called?
Qualified Business Income.
There you go, and 199A. But then the $50,000 you would owe 15.3%. Then both sides of those flow down. People always have this question. So you can reduce taxes by becoming an S Corp, but you got to hire a good accountant to figure this out for you, or you really should. And then it all flows to your personal tax return. You still owe state and federal income tax. State if you're in Minnesota, California. If you're in South Dakota and Florida, it's gravy, right? Yeah. No state income tax. But so that's how it works. Sole proprietor, S Corp, right? Now, each one of those scenarios, some things are going to change. Remember, so Social Security, the 12.4% right now, you'd only pay up to $137,000, and nothing above that would be subject in the current situation.
Right.
But Biden's proposal says up to $137,000 you would pay, or the current limit. You'd pay nothing from $137,000 to $400,000. This is what we're anticipating, and then $400,000 and above, you start paying again. 12.4%.
Right.
So in the case where you made $600,000, right, you have $200,000 now subject. So everything above $400K, so from $400,000 to $600,000, that would first be subject under Biden on a new 12.4% tax, which rough and dirty is going to end up being
$24,000.
So right off the bat, that $200,000 that they made is now $175K. So we just sucked $25,000 out for Social Security. Now, that's a big deal.
Oh yeah. I mean, that's a lot just in Social Security. You're paying an extra $25 in Social Security compared to the Tax Cuts and Jobs Act. I mean, 25 grand, that's a lot of people's salary you're paying now just in Social Security.
Yeah. And people can say, well, they can pay it. That's not necessarily the question. If you're in sales, you know that the best thing that can happen is somebody that is wealthy walking in with an additional $25K in their pocket when it's time to sell them a new lawnmower, when it's time to provide them siding services and they're thinking of remodeling their home. You hope they have an extra $25K that they can spend with you, right? What people don't understand is that having business owners, this is the great debate. Is it better that our government gets that 25 grand and then hires bureaucrats to hand it out to other people? Or is it better for that person to have it? I think that person should have it. But that's a major change. We're showing 600K. Now imagine if you made $1 million, right? Usually a millionaire is probably employing a handful of people, almost always. Right. So that's a major change. What else would you add to that? What other thoughts come to mind as we talk about that?
On the Social Security? Yeah, I mean, it's a really big deal, and especially you really want to make sure you have a right tax plan in place so that in this scenario you make 600. Like, well, how do we get that even further down? Like, what can we do? And you mentioned the S corporation. Obviously that's a really big tax saving strategy for many reasons, and it goes beyond just Social Security. But there's a lot of different things we can do now to get you that 600,000 down to 400,000, so that you're not paying that additional. We can, there's a lot of opportunities that come by just becoming an S corporation. Again, that's going to reduce. So it's making sure that you take a look at your individual plan and making sure that you're doing everything you can legally to get that taxable income down and saving more of that cash. There's ways to do it. It's just got to be proactive and plan around it.
You mean to tell me that all the wealthy people are going to go talk to their accountant and find out how to make sure that this law doesn't really hit them that hard?
I don't think that they're going to sit back and just let the tax come to them. They're going to be proactive.
Because they want to keep their money. Right. It's just a simple thing, and I don't care who you are. Here's another comment. How many tax... The firm we had and the folks that I know that do taxes, I have yet to bump up against any business owner or anybody, maybe one I can think of, that was like, you know what, round up. I want to pay more than I need. I want to pay more taxes than what that tax return asks for. Do you have a lot of people saying that?
No. And the people I come across who get mad about the people taking the tax incentives that the government wants us to take, they're also the ones taking the child tax credit, and they're taking their own incentives as well. So how is that any different?
And I don't think it's a liberal conservative thing. That's what's kind of funny about this. I get cynical with people who are like, let's raise taxes. I'm like, actually, like the billionaires, there's this, I read a couple articles that were talking about all the billionaires in the world have said, we can afford to pay more taxes. I'm like, good, just hand it over, donate it, give it, round up, send the money, put it in an envelope, send it over. And they're like, well, they can't. I'm like, bull snot. You know how I know you can? Because I talk to entrepreneurs that learn how to lower them. If there's this many tools to lower the taxes, all you do is release them all. But I guarantee you I get a little worked up about it, because it's one of those things that all of us, Democrat or Republican, liberal or conservative, libertarian or whatever, I was a little excited when that PPP money went into my account, or not PPP, but when that stimulus check hits my account. I don't know anybody who doesn't take whatever incentive they possibly can and go with it. So I think the answer is to not do it at all. But anyways, that first thing, that Social Security change, is a big deal. Yeah. That's going to impact. Now, what's interesting is if you're listening to this and you're cynical of our point of view here, or my point of view, I won't speak for Matt, my point of view of, maybe you're aligned to that, but I'll give you an out. What you'll see is that people will say, well, the Social Security trust fund is actually broke. Like, in fact, there's not actually any money in the Social Security fund. They have kind of rated that. There's no fund sitting around there to pay out these benefits. We actually know that the benefits haven't been reduced enough in order to create a cash flow positive situation in about 4 years, I think. We have all these baby boomers hitting retirement. I think, what is it, 100,000 a month or whatever it is? I forgot. There's some great... Baby boomers are retiring like crazy right now. And they were a boom after World War II. They're the first ones to kind of partake in this Social Security thing. Our security net is about to get stretched more than it's ever been stretched. So I do understand that some people might be saying we need to fund this, right? I get it. I think the answer is to control payouts and benefits a little bit differently. I would propose just getting rid of all of it, but That's my libertarian side. I'm a little dicey there. So I can understand why people would say, good, let's fund it. Let's go. That being said, if you've ever done the future value, man, we're getting deep here, but so if you make $100,000 a year and you start to fathom that your employer has, when you work for an employer and they pay you, that 15.3% still exists. They're paying half and you're paying half. So between you and your employer, there's a 15.3% inefficiency between you and your money, right? And when you say, okay, what if I were to take $15,300 a year from age, let's just say you make $100,000 when you're 30, and you start doing the future value calculations of investing that in the market on an average rate of 8%, it is astounding how much more money you would have playing them, just being in simple index funds, being the S&P 500 versus the payouts that you're receiving from Social Security benefits, which go away when your spouse dies. Like there's this whole game that like Social Security is not as good as what people think it is. It's actually quite the ripoff, but I don't know. What thoughts do you have on that?
Well, I think you said enough for both of us. Either way, Social Security taxes going up with the new Biden plan.
And you brought up another good point earlier that our current tax situation compared to,
Oh yeah. So right now the taxes is low as it might ever be. And you think for the next foreseeable future, Biden's in office for another 4 years, maybe 4 years after that, if he chooses to run again. Who knows what happens in 8 years with the next president. But if you take a look at what happened in 2020 with all the stimulus money and the stimulus money coming in 2021 as well, trillions and trillions of dollars was being printed to fund stimulus. Well, that's got to be paid back somehow.
Those are bonds. People don't understand that. We print that money through T-bills, and they have to be paid back. We have to pay it back.
It's going to be paid back through tax revenue. And so therefore, like I said, with Biden being in office, like if he makes his tax changes, that's going to last for 4 years, maybe 8. But just the effect of all the stimulus, like can't afford for taxes to go lower necessarily. The government's going to say that. So I just think taxes are as low as it's going to be right now. And if Biden's tax changes take effect, they pass, let's say in 2021. Well, a lot of times that means the tax change will happen starting in 2022. Not always. He could be retroactive to 2021. We don't know. It's happened before. It's not the norm. But let's say that it does take effect 2022. Well, 2021 is really your last year at the lowest tax rates. And so really you got to be planning now, 2021, what are you going to do? Yep. Capital gains tax goes up from 20 to 40%. Maybe you take some capital gains hits now in 2021. There's a lot of different things.
So sell those properties you've been holding. Sell those stocks you've been holding.
Sell that baseball card you have that you hold it on, the Wayne Gretzky rookie card or whatever that you're making, anything, any capital gains, it might make sense to take that now. Also, it might, if you're making a big capital purchase, let's say you want to, your big business and you're going to buy an airplane, or let's say you're a normal business owner and you want to buy a new
CNC machine. There's all sorts of guys that buy CNC machines to do metal cutting, to do woodworking. Like it's not that out there. Buy a tractor. Buy a tractor.
Buy a new Range Rover, and you can take that as an auto deduction and get it fully deductible on your taxes through bonus depreciation.
Oh man!
But maybe we do that in 2021 when it's more of a benefit.
So call Matt this year, like literally call him this year and start doing this stuff now. Because it's 2021 already. But.
Sorry. The bonus depreciation. I mean, maybe you wait to do that in 2022 because your taxes are going to be higher. Oh, yeah. So therefore, you need the bigger offset. Sorry, I misspoke. Maybe you do the bonus depreciation on your Range Rover in 2022.
My assumption is they're going to get rid of everything that helps anybody, but maybe not.
Again, it's really looking at everyone's individual situation because it's hard to make blanket statements and tell you what you should do right now because everyone's different. Everyone has different goals. Some people might want to scale their business and have venture capital and sell it one day. Okay, then maybe the S Corp doesn't make sense. Everyone, it's so specific.
But some people want to keep it simple, and some people are like, I don't want to grow. All I want is as much money as I can out of my business right now. And it's funny. I talk to them all. I'm sure you do too. Like, goals are different. Let's go to that capital gains tax thing because that's the next. So Social Security is about to change big time, probably. We don't know for sure, but that's a significant thing. And if you think this doesn't impact you, I'm telling you, you just watch. As we start to see that Social Security get worse and worse because the payouts are actually pretty dire. It's actually pretty bad. Like Social Security isn't a big problematic thing. It's $400,000 now. That donut hole will go away as soon as they've acquired enough power to never have to get elected again. But that's a whole other deal. When we talk about capital gains taxes, help plain people understand capital gains taxes.
Yeah. So capital gains is basically the money you make on any type of investment, or you acquire an asset and eventually that asset goes up in value. When you sell that asset, the difference of what you bought it for to what you sold it for is the gain you have on it. And that can be a short-term gain or a long-term gain.
Short-term is if you sell it within a year.
Within a year, anything over a year is a long-term gain.
And it's usually stock, businesses, and real estate. It's usually what I see.
Yeah, that's the most typical. But again, going back to if you have a 1980 rookie baseball card and you've been sitting on it, like if you sell that, it's a capital gain. It's an asset that appreciated in value. But you're right. Stocks, businesses, and real estate are the most common type of capital gain. Short term, that's always been the same. That's if you sell it in the short term, you pay at your normal income tax rate. Capital gains is different. So capital gains long term don't get taxed like ordinary income does. You all know the different ordinary income tax brackets going from 0 to 37% right now, 39 with Biden. Long-term capital gains, there's only 3 tax brackets. There's 0, 15 and 20. 0%, 15, and 20%. Those are the tax brackets for capital gains. With Biden, though, he's going to make a 4th bracket, which is the 40%. So any gain you have that's a long-term gain will be taxed up to 40% if you make over $1 million.
Yeah, and this is so otherly to the 3 stages of people I just described, right? Your W-2 employee that makes $30,000 to $100,000, $90,000. This is just a different language. They have no idea, right? And I think that's fair. Your middle of the road folks, right? If you're a self-employed person, it's still kind of out there. But what people don't know is there are so many entrepreneurs and businesses that what they're doing is they're buying old shopping models, and they're taking those shopping malls and they're renovating them into, the Dunkin' Donuts with a gym next to it.
Right.
And when they buy it at this, they buy it at $7 million, right? They put $3 million into it and they want to sell it for 20. And what people don't understand is that our facilities won't get renovated. Sorry, I'm getting to the consequences of this already, but people get really cynical about this idea of long-term versus short-term capital gains, or not versus, but this idea of that's not relevant to me. It is relevant to all of us. The way that rich people use their money is they put it to work. And people don't know this. Like, even if you have most rich people don't just fill their bank account and just let it sit there. They're usually investing it into the market. If they don't like the market, they're deploying it into it's usually real estate that I see. They're usually buying real estate and either fixing it up and hoping for appreciation and then selling it. And then they're doing, what do you call it? Where you buy the next one.
The 1031 exchange, which also might go away in the new tax change.
Are you kidding me?
Which is huge for real estate.
Holy cow.
And so that's another planning implication maybe you need to take a look at in 2021 is if you need to make that 1031 exchange if you're a real estate owner, maybe you do that now instead of holding on until next year.
Holy cow. So you're telling me, so right now, just for people that don't understand this, I buy a property, I buy a little strip mall, right? And I buy a $500,000 strip mall, I fix it up, I rent it out for 4 or 5 years. All of a sudden, the economy does better, things are going up, and I want to sell this. And you have this option for when you sell it, you had been depreciated this thing, right? Part of the benefit of having real estate is you have this income coming in, but then you get to depreciate the building. And when you depreciate, and you might have these cost segregations or cost segregation studies where you're like, you know what, the roof, the ceiling, the heating, all this stuff, it wears out quicker. We're going to fast forward all these write-offs. And it's good. It causes people to improve buildings and hold real estate and develop land. Now, let's say I want to sell that and I want to upgrade.
Well, to that scenario, you buy a property for $500,000. Let's say in 5 years, it goes up to $1 million. It doubled. So now you have a capital gain of $500,000. You have to pay tax. And of course, now in the new Biden, it would be 40%. Most likely if you make over $1 million. So 40% on that $500,000. However, there is a rule in the tax law. It's called a 1031 exchange, and 1031 is just a tax code where where it's located in the tax code, where instead of paying the capital gain on that $500,000 gain you made, you can instead take that $1 million that you took out from selling your property, and you can go buy another building, and then you can defer all of those gains until when you sell that one, and then when you sell the next one, again, 1031 it again, and you can go buy and keep deferring the capital gains you're making on the sale of real estate. Mm-hmm. But it's possible, he's mentioned it, that the 1031 exchange could go away. So therefore, that's not an option for someone to go buy bigger and better real estate. You're stuck paying 40% tax on that $500,000 gain.
This is what blows my mind. Who listening to that? You can be like, yeah, stick it to these people that make $500,000. You understand the risk that's involved in holding real estate, for crying out loud. People sue you, you fall, you pay, like you're paying no matter what. There's so much difficulty in there. But I don't know, I cannot fathom this thought that people are like, you know what? Some of that should be ours. Like, you sold your property. It just blows my mind. We should take that money from you. It's theft. It just blows my mind. That's a whole other subject, but
it will slow the real estate market because of, again, people don't have as much money to go buy.
They're going to hold
bigger
stuff.
Yeah, they're going to hold it longer. They're not going to be so. Why would you sell it if you're going to pay 50% tax on the gain? Mm-hmm. So therefore, it's going to be harder to get into real estate if you're an aspiring investor, and then they're not going to be able to buy as upgrade to bigger and better buildings.
Let's talk about businesses. There's a whole world of people that, and I personally know, I'll just give you an example. I won't say who it is, but I know two people who are developers, and they know a rich guy. They know a rich guy that's sitting on a big old bank account that's been around for a long time. And that bank account earns interest, and that bank lends that money out. But what he prefers to do is to help these developers buy land, fix it up, make it nice, and sell it. But people also do that for businesses. You might buy the next, and I usually see this in like construction, home services. There's a ton of professional services right now retiring. In fact, CPAs, there's more doggone financial planners and CPAs right now retiring. So let's just say you're a financial planning firm, mm-hmm. and you want to buy a book from somebody. You're going to take that book, you're going to buy it, and maybe it appreciates over time, and maybe you have a hope of selling it. Welcome to capital gains, baby. Mm-hmm. So now all of a sudden, when you go to sell that, you've worked your buns off to improve everything within that business. We're just going to take 40% of it if it's over whatever.
Make over $1 million a year, which again, with very common capital gains, that capital gain puts you over $1 million. Mm-hmm. If you make a $500,000 capital gain on a building, you just have $500,000 somewhere else, and you're over $1 million.
So the consequences of this in real estate, it's that people are not going to do the transaction. They're not going to buy, fix up, hold, appreciate, improve, and sell. They're not going to do fixer-uppers. They're only going to do small ones. They're going to buy and hold, which whatever, maybe that's good. But that activity stops. That's economic activity that now stops. We are not going to have more properties get improved. When it comes to businesses, we're going to have fewer Marcus Lemonises, right? The Marcus Lemonis that buys a business, fixes it up, and sells it again. They're going to be more careful about that. They're not going to want to do that as much. They're going to rest on their laurels, hoping it changes. There are big consequences. The other side of it is if you own stock, right? A lot of people,
or
Bitcoin, stock, and you bought it here, and now it's up here. Boy, so first of all, you have the short term and the long term. If you sell it within a year, it gets hit kind of like income. It's a higher
you get taxed at your normal income.
But these long term, you just think about it. For rich people that are holding stock, there's a lot of people. In fact, I know a lot of people that work at Best Buy that have been being paid in Best Buy stock. They've been buying as much 30% off Best Buy stock since 1998, right? I was in there in 2001. I know people whose 401ks, their stock plans, they've got tons of Best Buy stock. Now, let's just imagine you have a couple of big years and all of a sudden you're like, oh, geez, you're owing a lot. It's not always 40%, but it's no matter what you're paying. Yeah. It's hefty. So what happens is people just hold the stock. And when people hold the stock, you're not having the activity in the stock. It stops activity. People don't understand that deploying capital and having capital deployed is what helps our communities. It's how you get buildings looking nicer. It's how you get more affordable housing. It's how you get renovations occurring.
And we could see a sell-off in the stock market this year if this comes to pass. The people sitting on long-term gains that they need to sell now to make sure that they get the 20% rate, not the 40%.
It's probably why he hasn't been real finite on any of his plans here, because this is probably the most consequential thing that happens. Love or hate Trump, he decided to help all of these through the Tax Cut and Jobs Act. He wanted to, or they appeared to have wanted to, improve these situations. So capital gains tax are going up. Social Security for rich people is probably going to go way up. One of the things that happened, let's talk about SALT. So state and local tax deduction. This one's this is annoying because it's really complex and people don't understand this. Before Trump's Tax Cut and Jobs Act, what would happen was you always have your federal income tax. And then if you live in a state that taxes you, not Arizona or not Florida, Texas, not South Dakota, Tennessee. Texas, Tennessee, they say, hey, come to us. We're not going to have a state sales tax or income tax. They do sales tax instead. Before the Tax Cut and Jobs Act, you got to write off the state income tax that you would pay.
On your federal return.
On your federal income tax. So basically, if I paid $10,000 in California taxes, I actually got to write that off on my federal tax return, right?
Right.
So think about that for a second. That means that the higher the state makes their tax, there's actually no consequence in the overall tax bill to people in the first method. So what you see is California and New York residents are having all of that state tax because they have really high state taxes. Mm-hmm. Those really high, that tax bill becomes a write-off against your federal rate, which is usually higher. So what was happening is states are kind of used to be kind of, we can keep raising taxes. It doesn't really matter. That was the principle. And the Republicans said, why would we be abetting and helping? Why should South Dakota people, their federal, they're paying federal taxes. California gets to pay a lower percentage, which I don't like any of this. All of this is dumb. But the idea is, why would we just help California drive up their income tax? There's no consequences for them doing that when it's actually kind of hurting those that have better tax policy. It's kind of this weird thing. So what they did is they said, you know what? We're taking away we're putting some limitations around this idea that you can, California, raise your taxes as much as you can because you're just going to write it off against your federal rate. They put some big limitations in there. So what happened is in California and New York and this is funny, I've listened to who's the guy that's always blinking like this and he's on YouTube. He was interviewing Mr. Beast.
Ben Shapiro.
No, not him. Oh, he wasn't talking like this. This was but it was, these YouTube creators that are in California and Los Angeles that make all this money, right? And they're like, yeah, man, Trump's tax plan is so stupid. My taxes are going up. I had to pay this accountant, and he's telling me it's going up. This is just dumb. So it's dumb for poor people. It's dumb for me. It's dumb for everybody. No. If you lived in a state that simply raised their taxes, knowing that there's no consequence to you over and over and over, so you just get to write that off, they took that away. So what happened is it kind of evened the playing field. I don't like any of this. I prefer a flat tax. But now what's probably going to happen is that in Biden's tax plan, they're going to take those away.
Yep.
So it's going to go back to the status quo where it won't matter in New York and California how high they raise their state income taxes.
Right.
Because you just get to deduct them off your federal.
However, there is going to be potential limitations on your itemized deductions, which that tax was an itemized deduction, but now there's going to be limitations. So if you hit a certain level of income, you're not going to be able to take the full amount. Let's say you have normally $150,000 of itemized deduction. Well, eventually you're at a certain income level, you're only going to get 28% of that.
Yep, true.
And so it's even reducing your item. So that's another thing, though, that's going to affect W-2 earners who have high itemized deductions. They're very charitable. They're giving away in charitable donations. High medical bills. These are all itemized deductions you're able to write off in your federal. Well, eventually that's going to be capped or phased out, essentially.
Mm-hmm. And what's funny is you get into that and then it's like, well, Rob, now I voted for Trump, but I didn't buy a hat because there's a lot of Trump I didn't like character-wise. I didn't like watching him in the Republican primaries just drove me nuts. I'm like, he's attacking my guy, Rand Paul. Like, that's who I liked. Meek little Rand Paul. But, so many people would look at somebody like me and like, okay, well, how is that a good part of that Tax Cut and Jobs Act bill? Folks, my overarching message is that wouldn't it all be nice if it was just a simple, I mean, I want Matt to have a business of helping people mitigate their taxes. I think that never goes away. But all that happens is we deploy more and more. All we do is play more games to try and reduce our taxes. Like whenever it gets changed, all of a sudden the accountants and the lawyers, it's kind of like, why are there divorce laws? Like, why do we have no fault divorces? Why don't we have like, let's just bring some sanity? It's because there's a giant group of divorce attorneys that make stupid amounts of money based on a percentage of assets that can handle. Anyways, I digress. So the SALT thing is going to change. Capital gains taxes increases.
QBI is going to potentially go away at a certain level, which is are going to be phased out.
So now this is this 199A QBI deduction, and this is probably going to go away with Biden's plan. It's something that came around from the Tax Cut and Jobs Act, right? Mm-hmm. So help me understand a little bit of what this was. Remember, we always have two scenarios. We have an LLC, which is, I say LLC versus S Corp, but it's basically a sole proprietor Schedule C versus an S Corp, and you want to do S Corps to reduce taxes. Yep. But what it was is you have they're both pass-through entities, and you have this income that goes from a Schedule C or an S Corp, and there's a portion of it that is like your business income. So now help me understand this QBI that showed up for Trump.
Yeah, so for Trump, it was really trying to help the small business or help business in general. Obviously, corporations got the lower corporate gain or corporate tax rates, but the Tax Cuts and Job Act wanted to be able to help small businesses compete with the big guys. And so there was a lot of policy change for small businesses. And one of these things was the QBI deduction, which basically says that you're able to deduct 20% of qualified business income against your taxable income. So
this QBI is this calculation. It's not necessarily your taxable income. It's kind of like
qualified business income, essentially. So if, let's say your qualified business income was $100,000, well, you're able to take $20,000 and write that off of your taxable income. And so that's a big benefit. It's 20% you're able to reduce from your taxable income. However, after $400,000, you're going to be phased out under the Biden plan of that QBI deduction. So it completely goes away after $400,000.
So again, the big question is it better for my neighbor down the road who employs 8 people and has they're all over the place down where I am because I'm kind of out on the edge of the suburbs. There's all sorts of construction guys that own land. You know, they've got 7 or 8 employees. They're making great money. Is it better for him to have that additional 30 grand or is it better for my government to have it? You know, those bombs are expensive. We got to pay for them. You know, missiles are no joke.
Right.
But I mean, that's a big deal. When it comes to that line of thinking, what are some other things that you're noticing? What tips are popping up in your head that people should kind of take note of and prepare for around that? Around
the QBI deduction? Yeah, I mean, it's really, again, I guess the planning on your situation and where you're at in the income spectrum and if you're going to start to be phased out, and if you're going to be phased out, finding different ways to get that money back, essentially get that tax savings back. Again, we don't know exactly how this will be implemented. None of this is official, like we mentioned earlier. This hasn't been released officially by the Biden camp. This is all just things that were mentioned during the campaign. So we're guessing.
And it almost seemed, and it's been left vague.
It's been left vague.
Almost purposely vague so that we don't know.
It was said that QBI would be phased out after 400,000, but again, we don't know how it's going to be. So again, it's just really sitting down with your tax planner, not preparer, your tax planner on your specific situation, where you're at, if you'll be phased out, if there's other ways to, reduce taxes and plan for the future, maybe, implement changes here in 2021.
Oh, that's absolutely. So I think things are going to change people, good or bad. I tend to be a little more cynical of it.
Yeah, that's just, and it's been kind of a downer on the changes, but again, like things change. It's just, life changes, life happens. It's really just being able to plan for the change and not just sitting back and letting the change, if 2020 taught us anything, it's we can't just, we can make plans, but things change and we have to be able to respond and react to that. It's the same thing with our business. When things change, be proactive and do something about it. Don't let the change just overwhelm you or overtake you. Fight back, not fight back, but again, just make plans, And so that's really what I would encourage. Tax planning is.
And here's the plug. I'm just going to plug you.
Well, it's an investment, but again, you're making more money from it. Some people, they get a tax plan and they might, see the upfront investment on that, but they fail to see how much you're going to be saving from that tax plan.
Yeah. So I think we should convert real quick. Let's kind of end this idea. So we have the long podcast. We got a series of videos that always come out here. But, if we were to just frame up, so what is tax planning from your perspective? What does it look like? Now, I love your model is actually really enticing. Your model is a lot like a financial planner. So I think the best financial planners, rather than grabbing all your assets and then charging 2% all the time, right? What they do is you pay them 10 grand up front to write you an excellent plan. Yep. And they're going to show you plans that are going to save you money in fees on your mutual funds. That's what people don't understand. You're going to have way higher payment in those. But the idea is that initial investment on the plan is actually going to pay dividends genuinely. Mm-hmm. Like, people don't understand genuinely how much tax there is to save. Man, in fact, you can kind of look at Trump. The difference between somebody who starts to get into real estate because that's where all the tax code is, starts to provide jobs because that's where all the tax code is, starting to get into, should you use SEP IRAs, solo 401ks, individual case, 401k plans. There's pension plans you can do to push off $200,000. You can do giant deductions. There's so many opportunities out there, but you got real estate, you have your corporation. Like, people don't know, if you make $60,000 to $300,000, there's probably 10 things that Matt would be able to put together on a tax plan that are going to cause tens of thousands of dollars.
Not just this year, but every year going forward.
Every year. So if you call Matt, and I don't know where your pricing is if you want to bring that up, but the idea is help us understand, if you were to dive in, create a tax plan for somebody, what are they usually looking at? And then I want to talk about, like, you extrapolate the savings, just do the future value on some of this calculation. Yeah. It's crazy. What does it look like for kind of small, medium, maybe that 130 and that 600? What type of tax planning process and pricing is that usually for you?
The planning and pricing?
Yeah.
Yeah, again, the pricing is going to be very specific on kind of what the strategies we're going to be implementing, how we're going to do it. But I guarantee whatever the cost is, your savings will be at least 3 times more than that. Oh, yeah. In just the first year, not including year 2, year 3, year 4, year 5 years. And then the amount of savings you make, you're able to deploy again in investments and make more money off of that. So while the pricing is very specific depending on the plan, just know that you're saving at least 3 times more than that.
And we had a firm a lot like this, and they do a good job. I really like what Matt does. I would absolutely head to Matt's website, and it's Accounting FWD. So it's accountingforward.com, Accounting FWD. And Matt does a phenomenal job. I'm just getting to know him a lot here. We're in the same office, and it's been cool to hear his perspective. But folks, if you start playing the movie forward, Dave Ramsey always teaches this, right? If you were to invest, $200, $500, $1,000 a month consistently over the next 25, 30 years, how future value just escalates because you're using compounding interest. Imagine you talk to Matt and you genuinely, I just did this. We had customers all the time making $150,000. You make them an S Corp, you do a little this and that with the solo individual Ks, and all of a sudden, you're able to put away $12,000, $20,000, $30,000 a year into these super tax efficient. It's money you basically printed because all you did was implement the right strategies. You take that money, you invest it. Genuinely, Matt could make you a multimillionaire just by taking tax savings and putting it into the right investment funds. And you don't do investments, but we agree.
Making sure you have the right tax plan investment is part of the plan, making sure that, and again, it's all very specific to what your goals are. And your plan is for the future. And that's going to determine what our tax plan, tax strategy is going to be. So it's very specific in your goals. And a lot of the times, like, you're not just making money from the tax savings, but the way we save on taxes is by doing activity that makes us money. Yep. If you're going to take that money and invest it in real estate, well, that's an activity that's going to make you more money as well. Like, it's just
more tax efficient money. Even.
Right, exactly.
Yeah, it's awesome, man. So I would, go to accountingfwd.com. and get a call that he does a consultation, kind of an initial analysis. And then
we're going to free, and I'm going to be able to tell you how much you're going to save before you even spend $1.
Yep. And it works. I would end with this last story. We had a gal, and God bless her and her husband. I won't say who it is at all, but they're a local company doing stuff in the concrete world, very specific concrete. They've been in business since the 70s, mid 70s. And she was the accountant, and he was the guy that went and did everything. Their sons are involved in it, right? We connected with her, and she had been just moving forward, doing the tax. She did her own tax returns and stuff. Not a big deal. They had a CPA look at it every once in a while because they had some audits pop up here and there. But we looked at it. They'd been doing no tax planning since like 1978. And when I showed them how much they were going to save in that first year, she thought we were lying. We're talking $20,000 each, $40,000 a year in tax savings.
I saved
35 years.
Not too long ago, I saved a client $18,000 by just filing one form. I filed the form, $18,000 for the tax savings.
Yep. And I would even say one of the things that people don't understand is folks that build typical tax firms where it's all about the tax return. They're also accountants. And I want to be really careful here. Accountants and engineers think alike. They think costs, they're careful, they're risk averse. And generally speaking, accountants are all about, they wouldn't want to upset someone. They would love it if somebody would, well, I do $150 an hour to do tax consulting. And that's the most you ever get. And maybe they convince you to spend $200 to do tax consulting. And out of it's like, well, you should buy a truck. Like, it's not bad, but that typical model where they're doing, the only way they make money is doing more tax returns. And when you do more tax returns, you can't even, first of all, you're a historian. You can't tell anybody how to save in 2020 anymore. 2020 is done. There's a couple of things you can kind of do, but it's done. So if you're just talking to your tax guy now, too late. It's time to save taxes for 2021 now. And you got to get these strategies lined up and implemented because there's some strings you got to pull. There's some forms you got to file. Not only that, but when you have somebody who's focused on strategic wealth and tax planning, what you're going to see is that they know how aggressive to be. I literally can't count on my hands, fingers, and toes how many people we would bump into that have been nobody leaves their accountant. They've been at this accountant forever, right? And they are an S Corp and they're making, and it's usually I make $150. It's usually what it is, right? That's the most common. And my salary is $125. And you're like, why? And they're like, I don't know. We just wanted to be conservative. There's no thought into what's going into how are you determining your reasonable salary. Just nothing. And all it is they look at I've seen this. They look at the box and they go, well, what do you think their salary should be? And then they file Matt is in tune to what are the best practices? What are the lines that you can ride in terms of how aggressive you ought to be? And how do you make a wise, informed policy of how you would make those decisions going through so that you're protected too?
And if your accountant is doing things because they're afraid of the IRS, I think you might have the wrong accountant.
Oh my gosh.
I think what I've learned from going through accounting, getting my CPA, working for the public accounting firms is, the A and B students, the A students out of college go to the top accounting firms and the B ones go to the, regional lower level accounting firms because again, they're recruited but the C level students, they typically go work for the IRS. So making sure that you go and hire, one of those A level, B, accounting to be able to, who know more than the IRS. And so if your accountant is afraid of the IRS, well, they shouldn't be.
No.
So making sure, if
the first time I heard my best friend Nick on the phone, so he's a CPA, he came from a big firm.
Yep.
And he had gotten this from some I can just see their partners. The first time I heard him talking to an auditor on the phone, I'm like, holy smokes, he was sticking it to him. I couldn't believe it. I was like,
well, accountants coming out of college, when you're choosing where you're going to go work for, why, if you had the two options between an accounting firm, like I went to a big firm out of college, or the IRS, you're choosing between going to a place where everyone likes you and loves you and that you're saving them taxes and so they're your friend, or you can go choose to go work for a place where everyone hates the ground you walk on as an IRS agent. So obviously the best choice is to go work for the firm, and those are the better students who get recruited. I mean, I'm not trying to crap on the IRS here, but.
Or they go work for the IRS for 3 years and then they jump out like Sandy Botkin and then just teach people how to do everything possible. But yeah, man, to have an accountant grab that phone if that IRS agent calls and just shake them down. We're not giving you that. No. I couldn't believe it. They're asking for this stuff. And he's like, what makes you think you get to ask for that? I'm like, whoa. It was probably it was crazy though. And it was, they backed off, man. It was insane when I saw that. But bottom line, accountingfwd.com, accountingfwd.com. Give Matt a call. It's worth it. And this has been fun.
Yeah.
We'll be doing more of this. I think we should talk about more subject matter. We got all sorts of fun stuff.
Yeah, I'm happy to be on anytime. I love talking taxes. Most people don't let me talk about this stuff. So
it's so exciting. It's so riveting. So good luck. God bless everybody. Appreciate your time. Take care.